Hey everybody, it's Jack and welcome back. Ooh, a nice little rhyme there. Anyways, getting into the video, today I'm going to be doing something a little bit different. I'm going to be covering some stocks that I haven't really talked about a whole lot on the channel. I've been covering a lot more of the kind of higher risk penny stocks, as well as the safe and kind of stable dividend stocks. Today I'm going to be going right in the middle with just your average growth stock. So these are companies that don't pay a dividend, but they're not as volatile and risky as the overall penny stocks are, and they all have a market cap over $1 billion. So they're a little bit more established than those penny stocks, so they won't swing as much. The overall market's been pretty crazy the last 2 weeks, especially with yesterday. We saw pretty much red across the board and a pretty decent sell-off. It looks like we're heading towards that market correction territory, which is a 10% reduction in the overall stock market. We're currently around halfway there at around 5%. So today I wanted to cover 3 growth stocks that I think are really good buys for any portfolio with the dips we are currently seeing. I'm going to be covering 2 Canadian stocks and 1 American stock, all in very different price ranges. One of them is around $10 per share, the other around $30, and finally one is above $100. So it's quite expensive. It's definitely a stock you all know. And again, you might already even have these stocks in your portfolio. I just want to cover a little quick analysis on why at the current levels I think these stocks are all buys and some things they have going for them. But again, I'm not a financial advisor. These are just my own opinions. So always make sure to do your own research and due diligence. But with that being said, let's get into it. So I'll start with the least expensive stock on my list and then work my way up to the most expensive. The least expensive currently trades around $7.70 a share. It's a company that is in the crossroads of both the technology sector and the healthcare sector, a pretty deadly combination if you ask me. It's a company that focuses on the digitization of the overall healthcare industry, either whether it's through telemedicine or through electrical medical records. They do a lot of different things. The company I'm talking about is Well Health Technologies. You might have already heard of them. They are a crazy growth stock that has been seeing some extreme growth over the last year. They trade under the ticker symbol WELL.TO on the Toronto Stock Exchange. So let me go over why they are a great stock to buy when the market overall dips. So Well Health is currently trading at around $7.68 a share, down almost 10% yesterday. They started yesterday at $8.46 and went all the way down to $7.68 where they finished the day. Over the last 5 days, we've seen Well Health sell off from around the $9 range all the way down to where it currently stands. Well Health currently has a market capitalization of just over $1.2 billion. And if we look at the chart over the last year, we can see that Well Health has seen some extreme growth going from the $1.30 range to where it currently stands. They've seen some crazy growth because of overall what's been going on in the world has really caused a big push towards the telemedicine and overall digitization of healthcare. So let me get into why I think Well Health is a great dip buy opportunity. And first, let me just quickly explain to anyone who's new to Well Health what they overall do. Well Health is both a primary healthcare operator, so they have clinics, as well as being a huge innovator in the technology space, trying to combine healthcare with artificial intelligence, machine learning, and all these innovative technologies in order to better the experience for the overall patient. Well Health's core business strategy can be broken down into these 5 steps or words, which are acquire, integrate, optimize, productize, and scale. And boy, has Well Health ever been doing these 5. Over the last year, but specifically the last few months, Well Health has been growing like crazy through acquiring other companies. And once all these new acquisitions start to integrate, optimize, productize, and scale, I think Well Health is only going to continue to grow. On to the main reason I think Well Health is an amazing dip buy is that in its most recent round of financing, Well Health raised over $300 million by creating new shares to sell, and they sold these shares at $9.80. And who did they sell these shares to? Well, included in the group who bought these shares was Well Health's own CEO and senior management team. So the people behind the scenes who run this company were willing to pay $9.80 per share. If the people who know the most about the company and its day-to-day operations are willing to pay $9.80 a share, I think the price of $7.68 that it's currently at is a great deal. The stock is also currently at a support level around that $6.60 range, which is super nice. And worst case, if it were to fall below the support, it has another support at the $6.79 range, so it won't drop a whole lot. This means there's most likely a minimal downside, but a much greater upside to this stock, which is always great to see. And finally, How analysts are rating this stock is a strong buy. In the last 3 months, 6 out of the 6 analysts that have ranked this stock have given it a strong buy, with the low estimate being at $10, the average at $11.54, and the high at $13.50, given these are 1 year out in the future forecasts. And we can see that over the last month, 3 of these buy ratings have come in at $12, $11, and $13.50. So you're looking at potentially 75% upside to this stock. And at the more conservative range, a 40 to 50% increase over that 1 year time frame. These are crazy returns. The second growth stock I'll be talking about currently trades around $30 per share and can be found on both the Canadian and US stock markets. It's a company in the EV sector, which has been extremely hot over the last year. Specifically, this company focuses on hydrogen fuel cells, and they focus on large vehicles such as buses or transport trucks to carry them using hydrogen fuel cells. It's a really cool, innovative company that has seen a huge decline over the last month or so, a major pullback, and for this reason, I think it is an amazing opportunity to buy currently. The stock I'm talking about is Ballard Power Systems, ticker symbol BLDP. Ballard Power currently trades at $30 per share and has a market cap of $8.9 billion. So it's a lot bigger of a company than Well Health, and you can see that yesterday it sold off over 7%. And in the last month, it's gone from $52 per share all the way down to that $30. It's sold off over 40%. So it's trading at quite a low price right now compared to the past month. So a super quick rundown on Ballard. They are an EV company focusing on fuel cell technology. Again, the EV demand is supposed to increase enormously over the next decade. Ballard is engineering technologies for large vehicles such as large boats, buses, semi-trucks, and things like that. So they're in a different field from the Teslas and the car industry, which is great because it reduces the competition. Ballard closed another round of financing just over a week ago, where they sold shares to a new group of investors for $37 US. The companies that invested into Ballard Power were made up majority of the banks, TD, National Bank, BMO, and CIBC. So again, they were willing to pay $37 US for this investment per share, and it's now trading at $30. If we look a little deeper into the chart for Ballard Power, we can see that it shot up to that $50 range and it's come back down significantly, and it's now hitting a support level around that $30 range where it's been tested a few times before, which is really good to see. And if it were to break down, there's another support around the $24, $25 range. That minimizes the risk below, and we have a lot of room to run and grow above. So if we look at the analyst ratings for Ballard Power Systems, we can see that currently there are 7 ratings, 5 buys, and 2 holds. However, the 2 holds were actually issued around a month ago when the stock price was trading at that $45, $50 range. If we look at the breakdown for the spectrum, the lowest analyst rating for the 12-month forecast is $39. The average is $48, and the high is $53. So the average upside is 60% gains from the current prices. Pretty crazy stuff. If we scroll down, if we look at the last 2 months ratings that have come in, there's a buy at 48, a buy at 53, a buy at 49, and a buy at 50. So again, you're looking in the high 60s to 70% upside from the current price of Ballard Powers. So this is an awesome deal to buy at the dips. The third and final growth stock that I'll be going over today is quite a bit more expensive than the other 2 I just talked about. It's an American company that trades around $250, so it might not be perfect for everyone, might be out of people's price range, but at the current evaluation, I couldn't pass it up. I had to talk about it. It's a company that you guys all know. It's a technology company that is considered one of the FANG companies. It's Facebook, ticker symbol FB. So Facebook currently trades around $257 per share, and it was actually up yesterday, up almost 1% yesterday, which is surprising as the rest of the market sold off. And it has a market capitalization of $733 billion. So this is one of the mammoth companies. It's in the tech sector. It's one of those FANG stocks. So you can see one day it was actually up. If we look at the 1 month chart, Facebook has not sold off nearly as bad as the other growth stocks. So you can see that it's down only from around $275. If we look at the 6-month, again, just kind of 286 to 293 maxed out. So it's not down nearly as bad as other growth stocks. So the main reason I like Facebook as a growth stock to buy on upcoming dips is really its vast revenue streams from Facebook to Instagram to WhatsApp, as well as its price to earnings ratio based on its competitors and the other technology stocks. The price to earnings ratio is the multiple that the stock price is currently trading at based off the past 12 months of earnings. Facebook has a PE ratio of around 25, while Apple has a PE of 32, Google has a PE of 35, and Netflix has a PE of 84. So compared to its technology counterparts and competitors, you can see how Facebook is trading at a discounted PE to the others. If we look at Facebook's stock chart now, we can see that it has a nice support level around the 245, 250 range. So this would probably be where I would wait to get into. Wait for a dip down to the 250 range, make it sure it's bouncing off, and then get in right there. Looking at Facebook's analyst rankings, we can see that it's a strong buy overall with 32 buys, 3 hold ratings, and 1 sell. And that 1 sell was from a 0-star rated analyst. So I'm going to exclude that. So if we look just at the average and high on the right, we can see that the average price rating for 12 months down the line is $342 and the high is $375. And if we look over the past month or so at the analyst ratings coming in, we can see in this column for price target, they are all above $320. So there's a lot of room for Facebook to run over the next year. And you're looking at that 30 to 40% upside potential. So again, this is why I think this is a great stock to buy any upcoming dips. So there you have it, 3 amazing growth stocks to at least consider putting on your watch list for when the overall market takes these huge dips. These are all amazing stocks that I think have a lot of things going for them right now and going into the future. And these are all stocks that analysts are rating a strong buy. So again, consider at least putting these on your watch list for when the market dips. These are ones that you're going to want to watch. So let me know your guys' favorite stocks down below in the comments that you love to pick up when the overall stock market dips. I'd love to know. And again, I hope you guys enjoyed this video and smash that like button if you did. It means a lot for the channel. And subscribe to the channel if you want to stay up to date with all my latest content. I appreciate it, and I'll see you guys in the next one.